This is a short video on a refresher for engineering economy. I'm going to talk about two things. One is how you calculate cash flow from some detailed information you get about a project. And the second is how you calculate net present value, which is a way of evaluating whether the whole of the project is good. So if we look at cash flow, the first thing we'll look at is we want to look at the details of what is coming in cash, in a cash sense, and what is coming out. So things are going to be coming in are things like revenue or savings in labor costs. And the things that are going to be going out are expenses and taxes. So we need to calculate those. So we first start with revenue, which is equal to price times volume. We subtract out costs, the expenses, which is the cost per unit times the volume. And then there might be other expenses like operating expenses that also need to be subtracted out. And then we take out depreciation, which is a write-off of the initial cost. So you can't write off an investment in the year in which it occurs. You have to write it off over the time period of the investment. So that's what depreciation is. So from that, we'll get taxable income, which is revenue minus expenses minus depreciation. Taxes then is a percentage of taxable income. And then net income is equal to taxable income minus taxes. Then what we do is we take depreciation, the same as above, and we add it back to get cash flow. So it's net income plus depreciation is cash flow. So that's generally how you do the calculation. Let's look at an example where we sell 1,000 units of something for $10 a unit. The raw material cost is $5 per unit. And the depreciation is based on straight line or an even depreciation of the investment over the 5-year life. And it's a $5,000 investment. And taxes are 30%. So what is cash flow? So let's go ahead and do that calculation. Revenue is equal to price times volume. Cost is equal to, expenses are equal to cost times volume. Depreciation, which is write-off of the $5,000 over 5 years, is $1,000 per year. And then taxable income then is the difference between revenue, expenses, and depreciation. Taxes is going to be 30% of taxable income. Net income is going to be taxable income minus the taxes. And then depreciation, same as above, is added back to get cash flow. So in this case, the cash flow is $3,800 per year on this particular investment. So now let's move on to net present value calculation. So if you remember from engineering economy, we create cash flow diagrams that look something like this: an investment and then a return over time. So in the general equation for net present value is we take minus the investment, which is occurring in time period 0, and we add back the cash flow in each of the 5 years discounted back. And we use this particular factor, which if you remember from engineering economy can be looked up in a table, which is P given A, I%, find the present value given an annual cash flow at an interest rate for a number of years. And if the net present value is greater than 0, then it's a good investment. So again, let's look at this example where we have a $5,000 investment and then $3,800 each year for 5 years. And then what we're going to do is use this equation where we take minus the investment plus the cash flow times that factor. So it'll be minus $5,000 times $3,800, P given A, 10% for 5 years, because there's 5 years of cash flow. And then we look up that factor as 3.7908 and we multiply it out. And so we get a cash flow of $94.05. A net present value of $94.05, which means that it's greater than zero, therefore it's a good project. Now I hope that was a good little refresher on how to calculate both cash flow and net present value.